For the past 3 years, IBKR individual clients averaged 24.3% annually, beating the S&P 500's 23.1%. Lower costs and 170 plus global markets matter. Interactive Brokers, member SIPC. Visit ibkr.com/performance.
Welcome to Chit Chat Stocks, a podcast to help you find your next great investment. My name is Brett Schaefer, and I'm joined, as always, by my co-host, Ryan Henderson. We are not bringing you a power hour this week. This is our Friday episode. Both Ryan and I will be out of office. We're not doing a traditional live power hour with audience questions. And at the same time, we have gotten way too many recommendations for small caps of the week, which is kind of a weekly little segment we do, 5 to 7 minutes, covering an undiscovered smaller business, micro cap, in the investing world during the power hour along with our live audience. So we decided to do an entire episode dedicated to 10 small caps of the week. I'm sure we're going to call it something like 10 small cap hidden gems, 10 small cap stocks, blah, blah, blah. We'll get to the SEO stuff later for the title. Listeners don't care about that. But we're going to go through a similar format. We'll alternate. I have 5. Ryan has 5. We're going to do 5 minutes over the company. We have things, exciting things such as Duolingo, down to a company that does envelopes in Canada and is expanding into the United States. We're going to spend 5 to 7 minutes on it, and then we're going to talk about which ones we liked. Remember, these are not recommendations, but generally turning over new rocks that we may want to research further. It's important as an investor to have this filter, look at a bunch of companies, and decide whether a company is worth researching further or not. You're going to spend a couple hours looking at it in depth. Ryan, I have my first stock, but first, anything before we get started?
No, as far as structure goes for the next hour or so, Brett took maybe, I would say, more listener recommendations, and mine, and some of them were, most of them were companies I've never heard of. So more along the hidden gems route. I've got one listener recommendation, and then we wanted to do a few controversial companies as well to maybe spice things up.
Yep. Yeah. Stocks that have been high flyers that are down to small cap now, right?
Yeah. Former large caps, newly small caps. We can talk about those. Let's kick things off with your first one. This is a company I have never heard of. I believe this is a listener recommendation. Take us through it.
All right. It is Supremex. Ticker is SXP in Canada. Yes, this was a listener recommendation. Supremex is a manufacturer of envelopes, and it was a recommendation from a listener, JF. Don't fall asleep listening to this one. It could be a deep value play. I know envelopes isn't exactly the sexiest name, but look, there's always opportunity somewhere. Here's what JF said. They have a monopoly in Canada after buying everyone else and are also consolidating in the Midwest of the United States after acquiring many manufacturers in the greater Chicago area. They buy small mom and pop companies and often just take the order book and consolidate volumes in their existing plants. And they have begun diversifying into packaging too, boxes for medication, perfume, etc. So trying to get out of just envelopes into packaging for e-commerce and delivery services. Right away, I thought this was a potentially interesting deep value microcap. If there are some, returns, they have return on capital at a consistent rate, and they kind of trade at what you might put it as a forgotten valuation. 7 times earnings. Maybe the company does good with it, good with the cash that's piling up on their balance sheet, and investors forget about it. People go, "Oh, I like the hotter names." And they're just going to leave this out to dry. If you have a good capital allocator at the helm of one of these type of companies, that can do wonders for you. However, on the other hand, I worry that envelopes are a steadily dying business. They have some data on that. It's not going down as fast as you might think. And then on the other hand, they're also trying to go into some growth categories, e-commerce, delivery, and packaging. Here is a quote from the company itself. Over the last decade, Supremex has pursued a 3-pronged diversification strategy to sustain revenue and profitability. First, The company strengthens its position in the Canadian envelope market by leveraging its footprint through capacity allocation. Second, Supremex pursued growth opportunities in the U.S. envelope market by using excess capacity from Canadian facilities and through acquisitions in the Northeast and Midwest. Third, Supremex methodically built its capabilities in growing niches of the packaging industry, mostly through acquisitions, with the objective of achieving critical mass of the value added folding carton, e commerce, and label market. Now, I know people might get kind of, it's a serious business. People need these type of services. It feels a little bit like the Office TV show, very basic business. But they have a monopoly in Canada on envelopes. I think 85% market share. And if we look at the stock, first look, very cheap. Price to sales 0.3, price to gross profit 1, and PE of 7. Now, we look at that. They have a market cap of $90 million in Canadian dollars. And the questions I would have is, what is the acquisition track record? What is the competitive landscape? Are there any industry tailwinds? And what is management's capital allocation plan? Because if you're super cheap, you're going to have cash coming to the balance sheet quickly. We want to know what management is going to do with that. I feel like getting into the United States, which is a larger business for the envelope market, is probably smart. And then getting into e-commerce and packaging is probably smart as well, because that could be a more durable opportunity and maybe even a growth sector. Um, I would say I'd call this one interesting. You could probably call up the IR team yourself or talk to the CFO yourself if that is the entire IR team, because this is a tiny microcap. I think it's pretty interesting. And there were 2 slides they had here that showed optimizing capital allocation, which they had CapEx, which is pretty light, and then acquisitions, dividends, and share repurchases. They highlighted that they've done a mix of both. You'd probably prefer, as a shareholder, for simplicity perspective, to just have buybacks and dividends, but they have repurchased stock. They did pay a large special dividend in 2025, which I think makes the dividend yield look larger than it is, but they're still at a pretty high one right now. And then what I also thought was fascinating is that they really brought down the total debt on their balance sheet. They're pretty much debt free now. So cleaned up the balance sheet, might make it a simpler story. If you believe they're going to be at a 10% plus earnings yield, which for any beginner, that's the inverse of the PE. I mean, even if this isn't a high growth business, you might be able to do okay from here.
Yeah, this actually interests me, and I'll say for micro caps, which I would probably group as market caps under sort of $300 million. I like it when they're boring. I like it when they're kind of unsexy businesses where,
Forgotten.
yeah, they're very much forgotten. If my pitch to listeners on this is everyone else is falling asleep, so be the one that doesn't, and maybe there's some alpha there. I'm looking at the free cash flow over the last 5 years. Since 2020, they've averaged just under $30 million in free cash flow annually. And you mentioned the dividend. They had the special dividend last year, but judging by their free cash flow, and again, I haven't looked totally at the debt load here, they should have plenty of capacity to pay out, I don't know, I'd say 20 million or so in dividends a year. Maybe not quite, or I shouldn't say that. Call it 10 million. At that price, you're getting a dividend yield above 10%. So I do think there's some good returns here. Dividends, especially for micro caps, give me a little more sense of security because the capital allocation is always kind of questionable. So uh, if you get guaranteed payments, it kind of is a bit of a hedge in a way.
It's also more important if you're buying something that's low growth, trading at a PE of 7. And on your debt question, they used to have at the end of 2024 $43 million in debt. It was pretty much around that level for a long time. It's now down to 0. When you look at the enterprise value on an aggregator such as Fiscal.ai, they're going to have the leases included in that. I didn't look at the details on this. They did some sort of lease back agreement. That is going to make the EV look higher than it likely is. So I think their leases actually went up a bunch. That's probably because they sold the land or assets or whatever, and it's now an operating lease on their balance sheet. Probably shouldn't be included in the EV, but that also could be a good way to return capital to shareholders.
Yeah, just for context, estimates are for $30 million in free cash flow this year. take that with what you will. I can't imagine there's a ton of analysts covering this, but market cap or enterprise value today is market cap's 90 million Canadian. So you're trading at basically 3 times cash flow, price to free cash flow. Again, the enterprise value is going to be slightly higher. I honestly was, as soon as you described what the company did, I kind of tuned it out, but now I am honestly interested. This feels very cheap, and it feels like an industry that has been neglected, frankly, for a long time.
All right, let's get to your stock, Ryan. Number one, this one has been a battleground lately. It's a potential AI loser. The stock, I guess you're going to give context of how far the stock has fallen, because I think it's gone down a lot. Duolingo.
Yeah, I didn't even think about the AI disruption risk, but this was, we could talk about that in a second. At this time last year, Duolingo was nearing a $25 billion market cap. So would not have qualified for the show. Fast forward 12 months and an 82% drawdown later. And unfortunately for shareholders, as of 2 days ago, Duolingo does qualify as a small cap under our definition, which for this episode, I just went with below $5 billion market cap qualifies as small. Again, everyone kind of has their own definition there, but Duolingo's market cap currently stands at just 4.7 billion. So just sneaks into our hurdle there. What has happened to Duolingo? Well, let's start with the good. So Duolingo is the largest learning app in the world. They got there through a combination of an intuitive and sort of gamified user experience. If you've ever used Duolingo, you know what I'm talking about. They make you feel like you're progressing. It's kind of gimmicky in a way, but it's meant to kind of retain users. A lot of viral marketing and a lot of word of mouth. And it's worth spending some time on the marketing side because this is really important. I would also, the marketing that they do is kind of controversial, especially right now, but I would say they've done a pretty dang good job given the amount they've spent. I think if you were looking at Duolingo, you would assume that marketing expenses are probably one of the biggest line items for them. On the operating expenses, it's not. It's about 13% of revenue compared to, I think R&D is like triple what they spend on marketing. So they spend a lot more on tech talent than they do on marketing expenses. But the marketing strategy, it's known as unhinged corporate marketing, I guess is the term. It basically just means they lean into self-deprecating humor. So
I like AMC a little bit.
maybe I don't really follow them quite as much. But for example, so in 2017, they've always been a big push notification company. So they've always had like almost creepy push notifications or like weird, like they'll be like, Duo is so sad. Like, I can't believe you've not visited him in 3 days. And they'd be like their little mascot crying, which they actually, it got to the point where people talked so much about how creepy the push notifications were that they started running ad campaigns where it was like their mascot like creeping behind a window, and they really played into it. And this has honestly worked. They also had a recent campaign where their mascot proposed to Dua Lipa and got rejected. And anyway, it's this kind of gimmicky, dumb stuff, but it worked for expanding top of the funnel. And you think about it today, you mentioned Duolingo. Maybe it's just my friends. Everyone knows what Duolingo is. It's become very much like synonymous with sort of gimmicky language learning, and it's been great for virality. However, it seems Duolingo is starting to run into a wall growth-wise. So monthly active users have sort of flatlined over the last couple quarters. They grew just 6% year over year in the latest quarter. And there's part of this is by design. Brett's sharing a chart here with the MAUs. I mean, it's been fantastic growth for the last 6 years, but yeah, starting to stagnate now. So part of this is by design. And I think what caught people off guard is that maybe they're closer to saturation in terms of people not hearing about it than initially anticipated. So if the total estimated addressable market for mobile language learners is 1.5 billion people, apparently, whatever that, take that with a grain of salt. If you use some basic churn assumptions, you can back into the math that Duolingo has had probably at least 500 million unique users over their life. So a decent chunk of the TAM. So probably 500 million people have at least tried the app. This top of the funnel marketing, like gimmicky duo mascot proposing to Dua Lipa, that doesn't really work for reattracting churned users. Like churned users have used the product. What they want is a better learning experience. So they're trying to basically shift their marketing strategy a bit at the moment to prove that they are making real substantial improvements in the actual learning path and getting people closer to real understanding of a language as opposed to purely just like knowing a couple words. So that's kind of been one of the big hiccups with Duolingo. It's like, yeah, it's great for whatever games while you're passing time, but it's not great for actually learning a language. They're trying to get over that hurdle. Here's where it becomes an issue. One, that strategy shift, we don't know what it's going to do to growth. And frankly, management doesn't know either. So here is a quote from, I believe, the CFO on the latest call. On bookings, our expected Q2 bookings growth of about 6% reflects a tough comp. The prior year quarter included the initial rollout of Energy, a price increase on our most popular subscription plan, and exceptional advertising performance. We do expect bookings growth to reaccelerate through the second half, with about 3 points of acceleration in Q3 and a further rise in Q4. To me, that sounds like we don't know how we're going to do it, but God, we really hope growth reaccelerates in the back half of the year. And it feels like they're kind of kicking the can down the road here. So the big question, I'll go through the valuation real quick and then we can talk about the big question. Duolingo has an enterprise value of $3.7 billion today. They've done $416 million in free cash flow over the last 12 months. They've paid out $141 million in stock-based comp over that time. So call it $275 million in free cash flow minus stock-based comp. That means they trade at an EV to free cash flow minus SBC of around 13 times. What does Duolingo have what it takes to reaccelerate growth? Can they get back on the path? My honest answer is I have no idea. I don't see. I could certainly see a world where they do, but I could also just see continued stagnation. Potentially there's long-term AI disruption risk. Potentially there's sort of just, I don't know, brand, what's the term? Tiredness?
Fatigue.
Brand fatigue. Yeah. So I don't know. If they do reaccelerate growth, returns will probably be very good from here.
Yeah, it looks cheap-ish. People love this executive team. They love the founder. My gut check, though, is do I really want to be betting on the founder for a language learning app or an educational mobile app? That doesn't sound like the best business to me. And well, short term, maybe they turn things around. They really accelerate. I wouldn't be surprised either way. But long term, I do think they have major AI risk because personally, AI has killed them for me. I used to be a user, didn't really feel like I was making progress. So with Gemini, I go, hey, I just have to do a daily query like, all right, every morning send 1,000 words in blank Spanish for me and have it in this conversation so I can read it and then teach me. I kind of narrow it down like, all right, teach me what these words mean. I want to learn 10 new words for the day. Teach me some of these local sayings, blah, blah, blah. You learn much better doing that. I don't think anyone's actually learning a language on Duolingo besides basic phrases. So yeah, I would be extremely concerned about AI risk.
Yeah, I think that's fair. It my question, I walked away thinking, is there some meaningful advantage that is sustainable for Duolingo relative to AI, relative to other language learning apps?
I mean,
And my
long term,
answer was
everyone's gonna like. This might sound weird, but long term, the trend is everyone's gonna speak English. So English and Chinese. So well, no one's gonna need to learn another language, uh, right? I mean, that's just the
plus
major trend. That's like a multi-decade thing, but still. And then
plus
technology, the
yeah, I was
AirPod
gonna say
thing. Yeah.
auto translation through. smart headphones. Yeah, I think that's
Major
really.
concerns, I would say. I think this deserves to trade at 10 times free cash flow. You research your investments, you analyze markets, you manage risk, but did you research your broker? For the past 3 years, IBKR individual clients averaged an annual return of 24.3% compared to 23.1% on the S&P 500. IBKR's lower trading costs, competitive rates, efficient execution, and access to more than 170 global markets helped investors keep more of what they earn and put more capital to work. Over time, the broker you choose matters. Interactive Brokers, member SIPC. If you care about performance, find out why the best informed investors choose Interactive Brokers at ibkr.com/performance.
Yeah. All right, let's hop to your second one. I could, I'll say probably a little less controversial. Take
Who
us through it.
knows? Who knows? They're replacing the claw machines in the United States with Japanese toys instead of American patriotic toys. The company is Genda. That's not the brand at all. The ticker is 9166 in Japan. If you're thinking, hey, how do I buy a stock in Japan? I'm living in a different country. Well, that's what our friends Interactive Brokers are for. Genda is a Japanese company, market cap $635 million USD, and they really said their goal is they want to become an entertainment giant through acquisitions. They're founded in 2018. Don't know much about the management team at all, but they started by acquiring a majority stake in Sega Entertainment. They eventually acquired all of Sega, and they rebranded in 2022, coming out of the pandemic, the Sega arcades as what are now called Geigo arcades. They're all throughout cities in Japan. In 2023, they acquired a company called Kittleton, which operates toy claw games at various retail locations in the United States, and has since started to use again this Japan-American relationship to put Japanese entertainment characters, which are growing in popularity, in these machines, and that has helped them grow. In 2024, they acquired a company that operates karaoke bars in Japan called Bon Bon. All I'll say about that is karaoke bars are very, very popular in the country. So that's not like a crazy idea that they're coming up with. It's probably a nice existing business, although, similar to what's a good example in the United States, like a Top Golf. You need volume at these locations, or I'm guessing your operating leverage goes down very quickly. They seem to have made many, many more acquisitions. I could probably list 10 other smaller ones. They even have a company in Lemonade called Lemonica. It's a quirky beverage that is supposed to be Instagrammy, TikToky. They have weird cups. You take a photo in front of it. I don't understand it whatsoever, but it seems to be doing okay. And I looked at their website. You can open a franchise around the world if you want. But back to the actual business, it's a mishmash of things. They're buying a lot of stuff. If you look at the financials, they are cash flow positive. They claim large levels of adjusted EBITDA, but there's a lot of acquisition related stuff that gets mixed in here. They're getting for 30 billion yen in adjusted EBITDA this year with a market cap of 100 billion yen. EV is 175 billion yen. They claim, here's what's interesting that might turn around the stock. It's kind of in the gutter. There is a moratorium on using stock to buy companies, the self imposed moratorium, which I take as a Japanese company, I would take that. I would trust that more, that they're going to be faithful to that. And that they're going to be using debt, cheap Japanese debt and cash flow going forward to acquire stocks, but acquire less. My questions would be, who is management? Why should I trust them? What have the acquisitions in the ROI been? If acquisitions slow down, what could free cash flow be? And really how durable these operations are. That's about it. There was more from the listener that suggested this one, whose anonymous name I think is Mr. Seymour Duck. If that's supposed to be an innuendo, I'm sorry for anyone, but let's see if I can find it. I think I actually sent him a message here. Okay, this is not good audio. I asked him what exactly his thesis was. He said recent pivot to shareholder value. They're moving from more aggressive to focus on strictly high ROIC. Management froze equity. They acquire high quality legacy arcades at dirt cheap multiples, 3 to 6 times EBITDA, and plenty of other things. Oh, and then under Japanese GAAP accounting, companies must amortize goodwill over a period of up to 20 years. In the US, goodwill is not amortized. So the cash flow might be better than what their net earnings might say on the income statement. Switching to IFRS might change things a bit. Yeah, it's tricky, but it could be extremely cheap. Feels like a solid growth market to take advantage of, Japanese tourism and Japanese entertainment growth.
Yeah, tricky is a good word for it. The big question I have is how durable are these businesses? Like, I feel like you kind of need some sense of the social scene in Japan to have a good.
So these arcades, at least the one that my friends and I visited, which is funny enough, a Geigo arcade. I, as a value investor, was not pouring my money into these claw machines, but I was watching people do it. They were crowded, and they were in kind of like, say, a big commercial strip where there's just probably throughout a day tens of that, maybe 100,000 people going through this area, and you just pop in and go, "Oh, I'm a tourist. I want to try out this Japanese entertainment thing." It feels, yes, very tied to tourism, but I don't know how that slows down in Japan anytime soon. Maybe airline prices
Yeah,
kill this one.
it does look really cheap if these operations are durable. Let's hop to my second stock for the day. So stock number 4 on the episode, Bill Holdings. This is one we actually looked at, I want to say 5 years ago, when the stock was trading at literally 100 times sales. Used to be Bill.com. They've since rebranded. This is a back office financial management software provider for primarily small, medium-sized enterprises. And surprise, surprise, they are yet another casualty of the SaaS apocalypse. In the post-COVID SPAC era, they fetched a market cap as high as $34 billion. Today, they trade at a market cap of $3.8 billion. So
That was
roughly,
crazy.
yeah,
That valuation, that first valuation was nuts.
truly. Quick note, and I know I sound like a broken record here because we talk software stocks all the time, but with the entire software sector bombed out, I do think there are probably going to be some small to mid cap, maybe even some large cap as well, software names that are going to make phenomenal investments over the next decade. If they are not like, if they are misconstrued as an AI casualty and really it's like a benefit to their business or maybe just a net neutral to their business, I think some of these trade at really reasonable multiples. But as far as operations go, Bill focuses on 3 main areas for clients. So number 1 is accounts payable. They automate how businesses pay their bills. So it uses AI to read invoices, routes them to the right person for approval, and allows for one-click payments in multiple methods. So like ACH or whatever. The payments are going through Bill as well. Accounts receivable, so automates how a business gets paid. It allows businesses to send digital invoices, track when they are opened, and set up automated polite reminders for late paying customers. That is probably what they're best known for. I mean, it's kind of embedded in the name, Bill.com. Really, the accounts payable and accounts receivable is sort of their bread and butter. And then the third arm of their business here is spend and expense management. They got into this business through their acquisition of Divvy for $2.5 billion in 2021, which I know sounds like an extreme valuation to pay for this, given that it's almost their entire market cap today. But keep in mind, it was a stock acquisition and they were trading at a price to sales multiple above 100. So you honestly, sometimes the right thing to do is use your stock to acquire other businesses if it's productive for your existing business as well or helps it. But this segment is basically just corporate cards with built-in pre-approved limits, which doesn't sound like a $2.5 billion company to me or product, but nonetheless, people use it. And there's been good growth in that segment as well. To give you an idea of the kind of customer Bill is going after, their biggest competitor is really QuickBooks. So it's these smaller operations that are using like just the smallest form of accounting, and QuickBooks has like invoices embedded into the platform. As you get slightly more complex in your operations, that's usually when companies will graduate to Bill beyond QuickBooks. So I imagine a lot of their customers actually use QuickBooks for accounting or whatever, and then also have a Bill subscription for more of the accounts payable and receivables. The growth has been really, really solid over the last 5 years. basically 50% revenue CAGR. Granted, it's slowed in recent years, but still double-digit revenue growth over recent quarters, and they have turned the corner basically to profitability. But I guess one quick caveat here is that Bill earns about $150 million per year out of $1.5 billion in revenue purely on float interest. So when you schedule a payment, it sits in Bill's accounts for 1 to 3 days before it's processed, and Bill is collecting interest on that. So they are somewhat interest rate sensitive, which is why we've seen over the last year a slight decline in interest revenue despite payments volume growing. So overall thoughts on the business. I do think invoicing would be one of the lower hanging fruit areas for AI to disrupt, but so far we haven't seen that play out in the customer numbers. And there's a lot of sort of additional workflows around invoicing, accounts payable and accounts receivable that Bill provides that, again, small businesses, I think people are overestimating how much they're going to use AI to do every part of their business. I think sometimes they want a white label solution out of the box that works perfectly for what they're doing, not building everything from the ground up with Claude. Most of these businesses probably don't use Claude on a daily basis, at least to build internal applications. So I kind of think this will hang on and grow for a lot longer than people suspect. Let's talk valuation real quick. $3.8 billion market cap. They've got $2.2 billion in cash and equivalents on the balance sheet, but $1.8 billion in long-term convertible interest-free debt, which is kind of a nice to have for them. So $400 million in net cash. Enterprise value, 3.4. $379 million in free cash flow this year. So about 9 times free cash flow, but about half of that, more than half that, is in stock-based comp. So again, one of those sort of criminal SBC issuers. It looks criminal now, but if you're trading at 100 times sales, it makes sense to be using SBC as a tool for attracting talent, frankly, because it's essentially a cheaper form of currency. So it's kind of hard to fault these companies when they were trading at ludicrous valuations.
I could fault them. It's setting up your employees to hate you. So it's short-sighted. But that's it. We could have an hour-long discussion on that.
Yeah, that's fair. It doesn't seem necessarily dirt cheap here, unless we start to see significant reining in of stock-based comp. And my gut tells me that there's a whole bunch of pressure on a lot of these software companies right now, especially these emerging software companies, to lower their stock-based comp line. Like, it seems like one of the biggest knocks on their businesses right now, because no one trades at a real GAAP earnings multiple below 10 because of this massive SBC line. And it's like leading to, I think, a lot of friction with investors, because it's that classic, like, oh, but what about stock-based comp? Yes, I think that's a fair critique. And my gut tells me management's going to really start to rein that in. They already have been. It's come down, I think, 3 years in a row now. So long term, I think the business is going to be okay. I'm pretty interested in this one.
Yeah, the business seems all right. I don't think it's going to get disrupted. It seems durable. I'm actually a recent user of the product on a receiving end of a bill, and it was quite easy to use. But I kind of maybe if it gets cut in half again, like why would I own this over something like Wix or Money.com? Same sort of ball game, same sort of sector, potential AI disruptors, but much cheaper. I don't understand.
Yeah, it's competitive. Like, I think it's a competitive industry. They do, I don't know, I guess I think the name does them a lot of favors, honestly. Bill.com. Like,
Sure,
if you're just looking for the first solution that you find, it ends up being a pretty good, I guess, digital real estate there. Yeah, it just, every time I look at these, I think this could work out. But what on earth were people thinking 4 years ago? Who was paying 100 times sales?
They're not that cheap, especially if you have to still expect like a 10% revenue growth trajectory, which can't happen for all of these companies. All right, let's keep it moving. My stock number 3 is named Karoo. For some reason, this company has 5 O's in its last name. I will say, please change this. It's not like a gimmick that works at all. It's a strange business name. It's a business that is a software and I guess sensor provider for the transportation and logistics market. Ryan, what?
Is this top 5 worst corporate names of all time from what we've
Yes,
studied? It's got
I
to be
think
up there.
so. Yeah. I mean, I like the ones that are either super vague or just extremely on the nose, like Bill.com. Anything else really doesn't help. All right. Quote, Karoo is headquartered in Singapore and services more than 125,000 commercial customers and 2.68 million active subscribers in more than 20 countries. Globally, it sells software to help companies monitor logistics assets, mainly trucks and vans. They have a comprehensive suite of solutions like GPS tracking, scoring weekly driver safety, finding stolen vehicles, geofencing. Oh, hey, someone's out of their geofence. What's going on with my contractor? They might be stealing my van. Fuel management and charging and much more. For a large fleet, it sounds like it provides quite useful analytics and can be a cost saver if things go wrong. I'm sure Amazon, Walmart's, Targets, they probably have this type of thing internally, UPS, FedEx, what have you. For example, if you have cold storage for food and a truck has an issue, it will quickly alert you so you can get a fix out as fast as possible to not spoil your product. Funny enough, it actually has the largest presence in South Africa, which I guess makes sense given the huge safety issues in that country. Revenue has grown by 18% annually since 2019. It's at $307 million today. 70% gross margins, 28% operating margins, which means $85 million in last 12-month operating income, giving us a price or EV to EBIT of around 17. They're trying to expand into Latin America, Europe, and Asia. The big question probably remains, how successful is this expansion? Because to me, this feels like a business that not a lot of people are going to try to go after. And it looks like a good business. Like, how would you rip this out? You get good value, you probably pay a decent price, and you get a good ROI.
Yeah, I'd imagine high switching costs here. Uh, if you're embedded on a lot of these vehicles, it do you have any sense of like competition or what earnings growth could look like in the coming years? Do they give out any guidance?
Competition. I'm sure there's some other players out there. I'm sure some of the bigger ones have, like I mentioned, have their own internal services, but growth, it's been steady. I mean, did I forgot to put that in here? I think they are at like 18% annually since 2019. It's been pretty much up and to the right. I'd assume they just land and expand with operators. They talk about, again, the opportunity to expand into new geographies, which I think, Latin America and Asia would be quite promising, especially because, again, the safety issues, which are important when you may or may not be relying on local law enforcement, trusting them as much to help you get your assets back. The valuation looks all right. Singapore business, yeah, there's a lot of intricacies here. Singapore business, South Africa, kind of a little bit of a weird story, but the stock looks fairly cheap. I mean, 17 times earnings, pre-tax earnings, 18% durable revenue growth, kind of a small cap off the radar. I know this was another listener recommendation. Unless their capital allocation is just absolutely horrendous, I feel like this is setting up to be a decent performer and definitely one to put on the watch list.
How many investors do you think truly just write this business off purely after they see the name?
Ah, it doesn't help. That's fine. I don't really care.
Yeah.
It's a laughable name, but hey, I don't. Doesn't matter to me.
Yeah, like the business, don't love the name, but yeah, it does look actually pretty interesting. Let's jump to my third stock for the day. This is a company I had never heard of prior to this listener recommendation, so thank you for sending it in. It's Correios de Portugal, known as CTT. This is pretty much a sum of the parts story, and unfortunately, I wish I looked at this sort of 2 years ago. The cat's kind of out of the bag a bit on it, so I'll go through the different pieces one at a time. CTT what most people probably know them for is they run the national postal operator in Portugal. This is a regulated monopoly consisting of 569 post offices and 1,800 postal agencies. The business is in complete structural decline. Volume declines have been basically 5% every year for as long as the data shows, because it is cheaper and faster to send mail digitally. It's pretty simple sort of disruption theme there. CTT has been slightly offsetting these with price increases, but overall revenue has ultimately declined and margins have compressed. And also, I don't know, the whole price increases to offset consistent volume declines is not a formula I love, honestly, because especially with mail, because it just
That
deters.
ain't
It's not an
cigarettes.
addiction. It's not so like people. It just incentivizes people to go digital even more than they already were. Uh, anyways, this business I think is what people probably think of the most when they hear CTT. However, it's sort of become, I don't want to say an irrelevant piece of the story, but it's a very small part of the earnings or the aggregate earnings for Correios de Portugal. So today, the largest segment by revenue and earnings is now express and parcels. So separate fulfillment network, but it handles business to consumer e-commerce parcels. This business is growing, as you'd suspect, with online shopping overall. It's growing the top line 10 to 15% per year. And they've also seen, I believe, a big flood in of increased volume from some of the Chinese players. So like the Temus of the world and stuff like that. They this business seems solid, seems rock solid. Obviously replicating a fulfillment network isn't easy. It takes usually years, decades to build out. The third business here is Banco CTT. It has 789,000 clients. The business seems okay. It's a bank now. The one issue, and it's been one of the faster, apparently fastest growing banks in Portugal, and they use, I guess, their postal offices as sort of like pseudo banking offices. It generates about 20 million a year, 20 million euros a year in net income, but I think the hidden, we talk about this with banks all the time. You never know what the lending operations look like. You don't really know what the lending quality is. So management has actually been trying to sell down this stake so they can deconsolidate it from their operations so they can get it below 50%. It's not a huge piece of the puzzle. And then the last segment here I'll talk about is financial services. So this segment refers to CTT using their post office locations to be the sole retail distributor of Portugal's certificates of savings. So it was government bonds, basically. Business is pretty simple. They earn commissions every time they issue something. So and this has now been merged into the mail. So now it's called mail and services, but it's a bigger piece of earnings. In terms of earnings, it's going to be express and parcels, financial services, the bank, and then lastly the post office now, which is ironic because that's kind of what they're most known for. I'm going to steal some of the valuation work I saw on a good Value Investors Club write up. He basically says the mail business gives it a 4 times earnings EBIT multiple. He values the bank at less than 1 times book, so 0.9 times your equity. He gives express and parcels 12 times EBIT, and he gives financial services 7 times EBIT. I think those all sound reasonable given what I know about them. Again, don't know these businesses super well. That all leads to basically just over a 1 billion euro value on some of the parts. There's also a real estate part that I don't really know about, but anyway, just over 1 billion euros. In 2024, the stock was, I think the market cap was at like 300, 400 million euros. So you could get a double. Today, market cap's at about 800 million euros. So I think the cat's kind of out of the bag here. Also, I don't love some of the parts situations just in general. And it seems like management is trying to clean it up and make it just a true earnings story here. But I don't love some of the parts to begin with. I really don't love it when I don't know the parts well at all.
Well, yeah, you could learn more, right? That's the point of this episode, or the decision after this episode. But I looked while you were talking. The company seems to have bought back some stock. It has declined at a 2.8% annual rate since the beginning of 2023, roughly. So not bad. That could help a little bit on the, finding the true value within the business. Yeah, with these international kind of low growth, maybe you have that durable grower with the parcels business in the mix there. If it's trading at an extreme discount, it can get interesting. But I agree with you. If we're at, I mean, I'm looking now, and this could be a little misleading because there is the sum of the parts. PE is 17, EV to sales not zero point 0.9. Maybe that EV is totally off. Price to book is 3 now. I know there's financials plus operating businesses, so it gets a little messy on how to truly value it, but it doesn't look extremely attractive today. Yeah, maybe it works pretty well, but this would turn in from my first look of more of a deep value play into a confidence in the business quality to management play, and doesn't seem that enticing to me, especially in Portugal, low TAM. I'd want
Now,
deep value there.
the parcels business is also, it's Portugal and Spain, sort of a
Okay.
combo. But
Uh,
yeah, it's, I don't know, a lot of complexity here. And I don't know, I'm kind of borrowing people's valuation work, but it doesn't look like the upside is quite as high as it once was, given all the complexity risk I guess you're taking. But let's hop to your fourth stock. Got to keep it moving. Nano Dimension.
Yes. And before we do that, let's talk about our sponsor, Ryan. One you know quite well, your employer, Fiscal.ai. Use our link fiscal.ai/chitchat. Get 15% off any paid plan. Maybe you take them through the new product with a portfolio tracker that I
Yeah.
think many, many listeners would like to use.
Yeah, we just launched, as of this episode coming out, brokerage connections. So you can now plug in, directly link your brokerage accounts from multiple accounts uh, into your Fiscal AI dashboard, which is a huge quality of life improvement for any Fiscal AI user, because now you get real time updates and analytics. You don't have to basically update your positions manually anymore. It's all tracked. It's great. I recommend checking it out. It's free to connect your brokerage, so test it out, see if you like it. Again, if you do, any paid plans, 15% off with our link, fiscal.ai/chitchat. Let's talk Nano Dimension. Brett,
Yes, and
what is
this is
this?
one that I picked up on a Fiscal AI screen. I just kind of did high revenue growth, high gross profit hurdle on small caps, and picked something to look interesting. Nano Dimension, interesting name. I picked it up here. Here's what it says: "Quote: Driven by strong trends, and this is what their website says they do. Driven by strong trends in onshoring, national security, and increasing product customization, Nano Dimension, ticker here is NNDM, delivers advanced digital manufacturing technologies to defense, aerospace, automotive, electronics, and medical device industries, enabling rapid deployment of high mix, low volume production with IP security and sustainable manufacturing practices." So, what does this actually mean? They sell and use to make products highly advanced 3D printers for electronics, advanced manufacturing like aerospace, things like that. The printers are very expensive. They come with a razor blade model with the ink, quote unquote, being the metal dust. I don't know exactly how it works that people regularly buy. They also build products for customers with these printers. You're in defense and space, medical electronics. These are their main customer bases. I don't have the details on exactly who their core customers are. That's the point of the small cap episode, deciding if it interests us enough before diving further. Now, the company has shown strong growth a little bit through acquisitions, but they recently sold off their electronics 3D printing segment for, I think, what could be $10 million, and is now focused more on industrial and machining businesses. This is kind of from what I understand. And they're also working with an investment bank, I think Guggenheim, on a strategic review for operations. So we could see some value creation here. What's weird is this is uh, it's a strange story. It's potentially nice growth story, but the company has horrendous operating margins, I think negative 70%, and it's burning a lot of cash. Now, on the other hand, what's also strange is that it trades currently below the net cash on its balance sheet and has been repurchasing a little stock. So you're in a weird situation. because they have so much stock, they can buy back a little bit. I mean, given their burn rate, they have at least a couple of years left, and maybe they're seeing the strategic value. They're going to sell some stuff. Who knows? Gross and operating margins have begun to improve, but there's still a long ways to go with at least the operating margin portion. I'd say it's a very strange situation, but if you look at them and they have the strategic review, that could be a catalyst to split up the business. And there seems like there's going to be strong demand for these advanced manufacturing services in the years ahead, especially with the reshoring becoming a national security concern. 3D printing has been a little bit of a bust, but I think within these advanced areas, there are some potential capabilities. Again, space and defense is huge, huge product. It's just really, really helpful there. Do you remember a company named Desktop Metal? I believe they acquired them
Mhm.
potentially out of like bankruptcy, so they got them on the cheap. It's a mishmash of things, but maybe with the strategic review, net cash on the balance sheet, there's some value here, and shareholders could make out. All right, for one, am interested in maybe reading more of what management has to say.
Yeah, if there's a path to profitability here, or like if management shows that they actually care about profitability, I think this is interesting because you mentioned it. Market cap $391 million today. They have cash and short-term investments of 460 million on the balance sheet. So negative enterprise value. I would hope, given that they are buying back, that management is aware of the valuation and paying attention to it and thinks there's ways to generate returns for shareholders here. Business wise, I've got zero takes on sort of the longevity or durability of this business or even the competitive positioning. But yeah, it is interesting. I mean, anytime a company has a negative enterprise value, there is the potential for management to create shareholder value.
Yeah, it's messy for sure. It could get tricky, but hey, I'll say it again. If they're making these strategic reviews and they say they're on the path to getting to profitability, maybe it screens terribly on a valuation perspective. Maybe the profitability looks terrible right now, but there's an opportunity there. All right, number 4 for Ryan, one we've covered a long time ago. Nice interview. I'm curious how this company has been doing. Vera Mobility, um, the company that many people probably hate if they knew what they did.
Yeah, no, 100%. In terms of individual civilians, you hate this business. Shareholders, you might like this from here on out. This pat on the back to Brett here. I believe he gave it this nickname. It is the toll road on toll roads. So to be a little more specific, they make cameras and offer managed services on top of it that essentially give you automated tickets or give you automated toll charges. So there's two segments that really matter to this business. They also have a parking segment, but it's a small percentage of revenue. So it's commercial services and government solutions. On the commercial services side, Vera Mobility partners with rental car companies to manage the headache of tolls. So when a renter drives through a toll without a transponder, Vera's system automatically matches the license plate to the rental agreement, pays the toll authority, and bills the renter's credit card. Often, customers are going to hate this. Often adding a convenience fee, convenience in air quotes there. On the government solution side, Vera Mobility partners with municipalities and school districts to enforce traffic laws. So they are the company that installs, maintains, and manages red light and speeding cameras for cities like New York, Chicago, Pittsburgh, and others. And they also have, I didn't realize this, they have a school bus safety camera business where it attaches to the stop arms. Like you get cameras that attach to the stop arms, and it automatically captures the license plates of cars that illegally pass a stopped bus. So they
That
are
one's
the
nice. That's a good one.
yeah, they are the digital enforcer of tickets, basically, or tolls. Both of these as far as business quality goes, of so far of the companies we've talked about, this is number one for me. I mean, the switching costs have got to be really high. Both of the commercial and government services have generated
Plus,
15. Go ahead.
I was gonna say, plus government, they're just gonna set it and forget it.
Yeah, 100%. They've grown at 15% annual revenue. They've grown at 15% annually on both of these segments. Very similar growth rates, actually. It's not going to be hyper growth, but I imagine there's a lot of pricing power for Vero Mobility, especially with the governments. Once you've got the cameras embedded into all these locations and you're giving the government's ticketing revenue on a regular basis, the governments are going to appreciate it. I mean, Vero Mobility is basically a revenue generator for municipalities. So you can always kind of, I imagine, make the case that it's worth sort of eating the price increases. The expectations are for about $250 million in operating income this year for the whole business. They've got a $3.2 billion enterprise value, so EV to operating income around 13 times. I think it's pretty reasonable. Management has been buying back a lot of stock in recent years, so they've reduced the total shares outstanding by about 4% per year uh, over the last 2 years because the valuation's come down. I like this. I really do. It's boring. Maybe it's a hedge against any speeding tickets I get. It makes me feel a little better owning the operators here, but a reasonable valuation and honestly, high quality business.
Yeah, it looks pretty cheap. I'm surprised it's down so much. I wouldn't expect this volatility. Tip for the listeners: I got used to get hit with these. We had a super sensitive one, like driving right and not fully stopping at a right turn. At a light, you can understand what I'm saying.
Yeah.
And you can get out of pretty much any ticket, I believe, by just saying you were driving the car, which I wasn't. Full disclosure to anyone
In case they're listening.
at the time. Yeah, yeah. If you say that, they have to let you go. That saved me a couple $100. But in regards to this actual business, yeah, it feels pretty durable. There is probably if it gets big enough, there's potential political backlash from local places. I've seen it before. I actually grew up right next to one of the harshest, like the neighboring town was the harshest traffic camera one. It generated, like, it's not a very big city in the whole state of Washington. It generated more than the rest of the state combined. I believe. Don't quote me on that. But even if there is some of that political backlash, it never turns into a giant thing where they get rid of them. You kind of just deal with them. And I think the revenue's got to be sticky. And you're right. It's similar to, well, it's not as potentially immoral because there is some safety concerns here, but it's almost like a casino or bringing on cannabis stores. It's a good way to generate tax revenue. Not as vice as this, but I would say I'm pretty anti traffic cameras.
Yeah. It's like a dystopian company, honestly, but I
Yeah.
mean, the service they provide is important to their customers and sticky. So can make for good returns as shareholders. Let's move to your fifth stock for the day. I don't I don't love this name necessarily, but I don't really know what it means. Prog Holdings.
Well, Ryan, it means progressive lending. Yes, another bad name. Thank you to listener Tyler for this recommendation. He says in the Substack chat, small cap of the week, Prague Holdings. Management has given guidance through 2028. Very attractive valuation, serial share repurchase, serves the subprime consumer with 4 financial products, progressive leasing, 4, money app, and purchasing power. 4 is a buy now, pay later solution. And again, the name of the company comes from Progressive Leasing on purchases. If someone is denied with their credit card at a retailer, you know what they do? They come in and lend money to that person. They can use a Prog product to finance the purchase due to the company's relationship with retailers. You gotta love the United States sometimes. Really lets you buy things. If you can't put it on credit card debt, we got another offer, and you're gonna buy that sofa just fine. There's also a subsidiary called Vive Financial, with traditional revolving credit for subprime borrowers. So that's not attached to any retail purchase. They have 4 technologies, a BNPL service. Look, first thing, looking at any sort of financial and payments business, I'm just going to look at the valuation. Consolidated net income has been positive every year since 2018. And that consistency is probably something to look for because, they've gone through a couple of weird periods here, inflation, the pandemic, and they've been positive every year. Now, shares outstanding have fallen by a 10% annual rate since 2020. That's interesting. The
Yeah.
PE is currently 10. So even if they don't grow, you can get solid returns if the business is stable enough just through buybacks and capital returns. They have a little bit of debt on the balance sheet, but nothing too crazy, and they're paying it down. And the big question is just around durability and loan performance. But these are probably shorter term loans and they're already pricing for consumer that's in distress. So all of these consumers that are buying with them are already in a recession. So that sort of risk, I think, is mitigated similar to the Dollar Generals of the world, any subprime lender, anyone that serves the poor parts of the United States economy. They are actually more recession proof than the Whole Foods, that Lululemons, the more premium brands out there.
Yeah, it's it doesn't sound great being a subprime lender. I mean, even the words sound like probably turns off a lot of investors, but
Great recession. Yeah,
yeah,
it just triggers a word in your head.
I mean, you're right. It doesn't take much growth from here to generate a good return. At 10 times earnings, they're committed to the buyback. I think you can get solid returns. I I mean, we recently had a pitch on Sezzle. Look at that company. They're
Yeah,
sort
haven't
of
they done great? Shout out
yeah.
to Mono Invest. What's his actual name? He might be listening to this right now. It's not my. It's
Oh my gosh. I'm blanking on it, but
I know you as Mono Invest. Sorry, that's if you're listening. But great pitch. People should go listen to that. Yeah, what's that stock up like 100%?
past 5 years up 600% total return. So yeah, I mean these can make for good businesses. Obviously, it's not like the dream customer for for most businesses, but they know what they're doing. They know the field they're operating in. So I like it, honestly. The big thing for me is like, is there like one horrible judgment day in 4 years where their loan book
Yeah.
just gets destroyed? That's kind of, I'd always be thinking about that as a shareholder, but at 10 times earnings, you're not taking a ton of risk.
Yeah, and that's kind of the thing. Like, oh, how many do they have decades of experience here? And I think it probably comes down to, do you trust management to be frugal uh, lenders? It's probably it at the end of the day. Okay, last stock, number 10. This is one that people, I don't think I've ever been to one of these locations, but they may not be in the Pacific Northwest United States. Maybe Ryan can tell me if he has. Academy Sports and Outdoor.
Yeah, if you're not based in Texas, you might not have ever heard of this company because 35% of their stores are in Texas. But yeah, it's one of the largest sporting goods retailers in the United States. I think it's 300 something locations in total now. They went public in 2020 after being acquired by KKR 10 years prior. So they were private equity business for a decade. KKR took them public at what ended up being basically a temporary peak in earnings. So, in case people don't recall
Shocker.
this,
Shocker. If private equity is dumping something out of the public markets, lesson there, right? They're dumping it onto
yeah,
you for a reason. Portillo's, I made that mistake.
yeah. The so in during COVID, I don't really remember this happening, but apparently there was a massive boost in demand for outdoor recreational goods. So like fitness equipment, like people were building home gyms, obviously, because they couldn't go to the gym, hunting, fishing, camping gear. They were buying for the few activities they could actually do at the time, which led to a massive jump in earnings. So to which also they weren't adding any new stores at the same time. So there weren't any expansion costs. So you saw a huge boost in operating margins. In 2020, to paint a picture of this, Academy went from 4% free cash flow margins to 17% free cash flow margins in 2021. So they quadrupled cash flow margins, and they haven't recovered earnings since. And there was also, yeah, Brett sharing the chart here. I've got comp store sales growth, and you just see a massive jump in 2020, 2021. They had 16% comp store sales growth and 19%. Since that time, they have had negative comp store sales every single year. So -6, -7, -5, -2 for basically 2022 through 2025.
And what I think is important looking at that, Dick's, who you're comparing it to, has recovered quite nicely.
Yeah, Dick's Sporting Goods is the largest in the United States. They have produced positive comp store sales during that same time frame. I'm not sure what's creating the outperformance from Dick's necessarily. I would think that the results would be generally comparable given that they cater to similar audiences. But results have improved over the last year or so. Comp sales are basically flat now. The operating income per store, which has essentially declined for 5 years straight, is starting to stabilize. They've got, or analysts expect $420 million in net income this year, $3.4 billion market cap today, $1 billion in net debt. So basically just over 10 times earnings, this year's earnings. I'm mixed on this one. I have been as a customer. I bought like a $30 soccer ball. It's nice. It gets you your quick fix for whatever the recreational sport is you're playing or whatever. I don't know why this would have positive comp sales from here on out. Like, I'm not sure what would drive that. To me, this feels like something that still would get eroded away by e-commerce or by Amazon. But I mean, I guess if they haven't by now, they've withstood the test of time. So they are also in growth mode at the moment. They added, I think, 24 new stores over the last year. So they're growing store count by almost 10% a year. I guess if you think they can get even low to mid single digit comp store sales growth plus 8% new stores, I think there's a recipe for growth here.
Yeah, PE is only 10. I don't love these. Even Dick's Sporting Goods as well. They've executed quite nicely. I just think of the ones back in the day. Sports Authority is where I used to go as a kid, and they're gone now. It's really easy to screw up this business, and you kind of feel like you go into booms and bust. Yeah, I don't love it, but it's cheap. So if you believe in this management team, it could be all right. I like Winmark with what is that? Not Value Village. Played against sports and other brands better. And that one's always expensive, but that's the one I have on my watch list for any sort of sporting goods. Because that's a great business model. People just give you your product.
Yeah, it's like Goodwill, basically. I mean, that's you've got quite the supply advantage relative to an Academy Sports.
Nice cost advantage. All right, well, that's 10 here. I have a concluding question, and I hope I can help out us and the listeners of potential stocks to research, rank, or just say the three. I don't really care about the order. The 3 companies out of these 10 that you have more interest in after this episode. I am going to go through right now and say Prog Holdings, Vera Mobility, and I'm not going to do the envelope company. I'm going to do Karoo, because I think those just have Prog may be more durable, not as big growthy, but Vera and Karoo feel like the durable growth at a reasonable price that just makes more sense as a buy and hold investment.
I'm going to go Vera Mobility, number 1. I'm glad I revisited it. The number 2, I'll go with Prog Holdings as well. Good valuation and committed to the buyback. And then number 3, it's kind of a toss-up for me between, we probably should call them by their name, but the envelope company, I think that one's actually pretty interesting. Supremex.
SXP on the Canadian exchange.
And then Bill Holdings is probably tied for 3rd with Supremex, but I think I need to see valuation come down a bit.
So we're both saying Duolingo going to 0. Yeah. No, I don't know what's going to happen, but it just seems risky to me. All right, Ryan, anything else before we get out of here?
I think that's going to do it.
Well, I guess I should have said we're recording this on May 6th and it's coming out over a week later. I don't think it's going to make that much of a difference. Maybe there's some earnings that are going to come out between now and then. We're not going to have any big takes on these stocks, so I don't think it should be a huge difference. But yeah, let's hit the disclosure and get out of here. We're not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.
I finally had a light bulb moment about a stock we've all heard about, growing at 18% a year and a 15 PE. I shared this insight in a special deep dive report to subscribers of my research service, Value Spotlight. The report is called A Generational Moment, Reigniting Human Connections Through a Tangible Network of Intangible Assets. Chit Chat listeners can get a discount to my research at stockwriteup.com. That's stock, WRITEUP.com.